The year 2026 so far has been a year of change. Changes in the capital markets, changes in technology, changes in the outlook for interest rates, changes in geopolitics. Where are we headed from here? Hello and welcome to the Cedar River Capital Markets Touchstones slideshow update. The date today is March 23rd, 2026, and today we'll be discussing what we believe to be the main factors driving stock and bond markets today and going forward. My name is Paul Latta. I'll be doing most of the narration today, but my business partner Bosch Kochar and I are both available for questions and discussion. Our contact information is on our website at cedarrivercapital.com. We'll begin our presentation today with a discussion about recent market action, stocks, bonds, other assets. Then we'll look at the macro economy to add some support behind the market discussion. Then we'll move to a microeconomic view and look at key industry-specific drivers. And we'll conclude with some longer-term observations about the investment landscape. The S&P 500 is up 16.3% in the trailing 12 months year-to-date through March 20th, as shown on the left. A good performance for a one-year period, though the market has pulled back about 7% from the highs set in January. That mainly reflects the uncertainty around geopolitics with the start of the Iran war in late February. The chart on the right shows the S&P 500 is up 78.8% over the last 5 years, and that there have been a couple pullbacks along the way, including the pullback that we're in today. The bond market is up 3.8% in the trailing 12 months. Much of the gain from last year reflected the tailwind of rate cuts from the Federal Reserve. More recently, the bond market has seen a little bit of inflows from a flight to safety move related to the start of the war in Iran. But some of that flight to safety move is actually reversed as war-related inflation fears are starting to spook bond investors. Over the last 5 years, bonds are up 1.2% as shown on the right. It's good to see the long-term returns finally get above zero and begin to put that bond bear market of 2022 in the rearview mirror. Oil prices have been dominating discussions in the capital markets given the sizable moves since the Iran war began late last month. As you can see here, crude oil popped over $100 a barrel in short order as Persian Gulf nations, Saudi Arabia, Kuwait, Qatar, United Arab Emirates, they supply about 20% of the world's crude oil, while they've not been able to safely ship any oil. The big price increases have been daily media discussion, not just because the price at the pump is lifting, but also the uneven effects on various sectors within the stock market, the potential for a lift in inflation, and what that might mean for Federal Reserve policy and potential future rate cuts. The Fed has been in a neutral stance recently, but with a modestly dovish bias. Rate cuts have been slow to manifest, mainly reflecting the fog induced by the tariff policies last year. But with the oil spike in the last several weeks, that dovish bias has moved more firmly towards a neutral stance. The Fed is basically in a wait-and-see mode. The consensus for future Fed rate cuts has rapidly moved toward a neutral stance. As you can see here, prior to the start of the war, Fed funds futures were implying at least 2 rate cuts in 2026. After the war started, that scenario changed quickly. Fed funds futures are now implying 1 cut at most, and that cut does not have strong conviction. The oil price spike was a global phenomenon, not just a U.S. phenomenon, so central banks all over the world have flipped from dovish to hawkish amid war-related inflation fears. Indeed, rate hikes are now expected in the European Union, Switzerland, Canada, England, and other important central banks. Indeed, Australia has already made the first hawkish move with a 25 basis point rate hike this past week. Whenever we talk about rates, of course, the outlook will change as fundamentals change. Should there be a rapid and orderly completion of the war, the hawkish changes we are seeing today could prove fleeting. This is a chart of the S&P 500 over the last 10 years in blue and the valuation of the S&P 500 using the price-to-earnings ratio in purple. As you can see, the S&P 500 has done well over the last decade, lifting just over 275%. Some of that is due to increasing valuation as shown in purple, but most is just improved earnings over the years. The price-to-earnings ratio, or the PE ratio, is 20.2 right now, which is just over the middle of the 10-year range of about 14 times to about 24 times. Stock market is not overvalued in here. Investment returns by sector have a sharp bias in favor of those companies that benefit from high oil prices, so the energy sector has been quite strong in 2026 so far. Many of the big drivers of the prior few years, including the Magnificent Seven stocks, well, they've been left out of the rally. The oil rally in the first quarter so far is manifesting in returns by style factor with a meaningful outperformance of the income and value styles and a noteworthy underperformance of the growth and momentum styles. Might also mention that most style factors at this point are a tad ahead of the S&P 500, an encouraging development for active managers. The U.S. S&P 500 is modestly underperforming most foreign stock markets, but the underperformance is not related to high oil prices. Indeed, the U.S. is a net oil exporter, so high oil prices have limited impact compared to earlier decades. But the U.S. is facing another headwind related to AI. As new AI capabilities grow, many of these new features are proving to be direct competitors to the existing software companies. Software companies have been under heavy pressure in the last couple of months. But the high oil prices are rippling through to other relative performances in other markets. At a broad level, big oil exporting countries like Brazil and Mexico tended to see stock markets outperform, whereas net importing countries like India, China, and Vietnam tended to underperform. While software stocks were under pressure, semiconductors continued to show big gains, especially those tied to memory chips. Indeed, South Korea's Hynix and Samsung were big factors driving that exchange to record highs. We used this chart before to show the big spike in trade policy uncertainty back in April of last year with the Liberation Day tariffs. Uncertainty seemed to moderate in subsequent months, but we did see a small secondary spike in late February of this year with the Supreme Court decision rejecting the presidential tariff authority. We suspect tariffs will be less of an issue in 2026. Further, the Iran war, which started a mere 1 week after the tariff authority decision, tariff-related headlines will just not gather many clicks compared to war coverage, so that tariff narrative seems likely to fade quite a bit in 2026, especially compared to the drama of 2025. In our prior slideshow, we chatted about how individual stocks were seeing enormous moves in reaction to earnings reports, reactions that were about triple the normal size. This chart here shows that strange anomaly is not limited to just earnings calls. The size of the up and down moves of individual stocks is now at a 20-year record. This is especially noteworthy since the up and down moves of the overall S&P are kind of unremarkable. All the movement is happening beneath the surface, and it is profound. Lots of explanations behind this phenomenon, but the elephant in the room is the algorithmic herding of retail investors. A great quote here captures what's really happening. This is the first cycle where retail investors can code, retail can backtest, retail can automate, retail can use the LLMs to generate quant signals, but they're all using the same tools. Yikes, no wonder we're seeing all these crazy record-breaking one-day moves in individual stocks. We'd now like to move on to part 2 of our slideshow, the economy. We'll begin by looking at GDP growth rates in the developed world. GDP moved forward in most regions of the world in the prior quarter. A handful of exceptions, of course. The U.S. turned in a fairly weak 0.7% growth, but with underlying consumption growth of positive 1.4% and some noise around that government shutdown, it doesn't really appear to be at risk of recession in the U.S. South Korea, a tad weak, showing a small contraction, likely a pause in the chip cycle. Of course, the chip business is again booming, so that soft patch seems likely to pass. A couple areas of notable strength. Japan bounced from the weakness in the prior quarter, mainly related to a pause in the auto cycle in the third quarter, which rebounded in the fourth quarter. Mexico similarly bounced from a weak third quarter, mainly on a revival of nearshoring and an increase in tourism. The start of the Iran war and the spike in oil prices resulted in a lift in the increase in the probability of recession for 2026 in the U.S. The betting markets, a poly market, is showing here a 31% chance of recession this year. We do tend to think that poly market is a bit overreactive to the war news, though yes, the probability ought to be higher. In contrast, Oxford Economics put out their monthly survey of economists in early March, which puts the probability at 17%, a more reasonable estimate in our view. Higher oil prices are challenging for most non-OPEC countries. While the U.S. is now a net exporter of oil, that does not mean the U.S. benefits from higher oil prices. Recall the U.S. is a consumer-oriented economy, and consumption is over 60% of gross domestic product. Higher oil prices will depress U.S. consumption, which will depress GDP. Also, higher oil prices will increase the hawkishness of central banks, meaning higher interest rates. As the chart here shows, for every sustained 10% increase in the price of oil, U.S. GDP declines by 0.11%. Since the war started, oil has increased just over 50%. If today's oil prices are sustained, U.S. GDP will see a headwind of 0.6 percentage points. The U.S. is not meaningfully worse off than other countries. India and Eastern Europe are actually quite a bit more vulnerable. In contrast, Canada and Latin America, well, they actually benefit economically from higher oil prices. Recent GDP reports in the U.S. have been noisy, with tariff front-running impacting inventory stocking and destocking. Also, lack of information around government shutdowns. But the core U.S. consumption figures seem divorced from most of this noise and actually provides a better sense of economic vitality in the last 4 quarters. We've seen a modest slowing in recent quarters, but figures still remain positive. Credit card delinquencies remain on the high side, but actually have been easing. Bottom line, consumption remains adequate. We chatted about this last quarter, how the artificial intelligence capital expenditure boom is adding a tremendous amount to overall gross domestic product, just over 0.7% in the prior quarter. Pundits have noted that GDP growth overall in the fourth quarter was only 0.7%, so if you exclude the 0.7% from the AI capex boom, GDP growth would be a dead flat zero. That's actually true. Of course, that fourth quarter GDP figure includes all that tariff up and down inventory noise, as well as the government shutdown. Raw underlying consumption was a little healthier at 1.4%, so perhaps that capex is not quite so meaningful when you look at the core consumption. Still, that AI capex is a meaningful part of the economy, and it seems likely to become more so. The AI capex spend was large in 2025, but it's on track to rise another 70% or so in 2026. This suggests that the AI capex in 2026 may be adding well over 1% to GDP, perhaps closer to 1.5% to our GDP numbers for 2026. The financing of that spend will be a topic of discussion throughout 2026, it seems. Now I'd like to move on to part 3 of the slideshow, shifting from macroeconomics to microeconomics by looking at a handful of industry-specific factors that are shaping overall capital markets. We'd like to highlight 5 industry discussion topics here: stocks during war, viral narratives, the SaaSpocalypse, the new radiotherapeutics, and fertilizer goes viral. Let's start with the most topical at present, stocks during war. I'm sure everyone has seen this map of the Persian Gulf and the choke point at the Strait of Hormuz that has been in the media repeatedly for the last several weeks. About 20% of the world's oil supply gets shipped through this choke point, a choke point that is largely surrounded and controlled by Iran. The closure of the strait is the main factor that has spiked oil prices over 50% within the days after the start of the war in late February. War in the Middle East is not a new phenomenon, and we have a decent grasp of what sectors traditionally move up and down and for how long. Of course, no 2 wars are identical, but this table shows the traditional winners and losers in a Middle East war, and it also shows how well they're doing in the present war for the first 3 or 4 weeks that we're in. Oil stocks and related food and material stocks are all lifting as would be expected. In contrast, anything that uses fuel is declining: airlines, trucking, cruise lines, and more. Also declining are consumer cyclicals like apparel, for example, as consumers put more money in the gas tank and less money into the wardrobe. Technology usually moves to the back burner as well, under pressure from higher energy costs. 2 notable quirks in the traditional winners and losers: usually gold rallies and usually defense stocks rally, but both sectors are victims of doing so well in the prior year. Precious metals in particular rallied strong on the debasement thesis amid tariff headlines last year, but it's faltering this year as war drives the US dollar higher as a haven of safety. Are geopolitical events actually buying opportunities? Short answer, yes. As we can see here, the S&P 500 gains about 14.2% on average after such events. And granted, there is a wide variance. However, the quote here from Nathan Meyer Rothschild over 200 years ago basically sums it up: buy to the sound of cannons, sell to the sound of trumpets. Let's move on to our second industry topic, viral narratives. I need to give credit here to Robert Shiller, the Yale economist, for his work on narrative economics, which shows the virus-like behavior of investment narratives. This chart gives an example of how the viral contagion process works, looking at the Beanie Babies craze beginning in the early 1990s. The red line in this chart shows the size of the so-called infection, beginning near zero in the early 1990s, then rising sharply in the mid to late 1990s as the virus spread, driven by internet forums and pricing guides. Full infection peaked in the US in the late 1990s, a veritable national obsession, but the virus slowly died off after 2000 as belief faded on using Beanie Babies as a financial asset. All investment narratives have this virus-like behavior, but not all viruses have such a textbook rise and fall like the Beanie Babies narrative. Indeed, the real-world viruses, investment narratives, can mutate into new forms. We've seen that, for example, with the gold standard mutating into Bitcoin as a form of digital gold over the last 15 or so years. Also, not all viruses die off like Beanie Babies. Some are recurrent strains that really never go away. They just lie dormant for a while and then flare back up. Indeed, Schiller identifies 9 perennial investment narratives that are always with us, but just cycle up and down over time. This table is the 9 perennial investment narratives, according to Robert Schiller. What I love about this table is how it shows that investment analysts like me and Baj have been wrestling with the same investment narrative viruses that our predecessors have been wrestling with for literally hundreds of years. If we look at the first line item here, the idea of a stock market bubble, well, that's not new. Indeed, fears of stock market bubbles, well, they go back to at least 1720, the South Sea bubble, and some might even go back further to the 1690s bubble in the deep sea diving bells. Today's manifestation of that ever-present stock market bubble virus risk is that, well, that's the fear of an AI bubble. Going down one more line item, we can see the perennial narrative of automation replacing jobs. And right below that, the related narrative of machines replacing jobs. Both those narratives trace back at least a couple hundred years to the Luddite Rebellion in the United Kingdom. Today they're manifesting as generative AI replacing white-collar jobs, and autonomous vehicles and robotics replacing human workers. I won't go through all 9 items on the table here, but some of the investment narratives have literally thousands of years of history, and all 9 of these are present today to varying degrees. One additional aspect of investment narratives is that large-scale economic narratives will break down into a constellation of sub-narratives. This chart shows the breakdown of the present AI narrative into a constellation of 10 sub-narratives. The strengthening or weakening of each of these sub-narratives is what causes narrative viruses to mutate. Another wrinkle of complexity on investment narratives is that big narratives can scoop up various uninvited guests into their narrative. We call these the narrative interlopers. The chart here shows how copper investments and merchant electricity investments have become AI plays, despite very little in the way of economic ties to the AI story. On the left, we can see that copper demand is dominated by China construction, yet copper-related media coverage is dominated by AI, thereby creating the copper fake news interloper. On the right, you can see the fake news interloper problem is even more problematic for merchant electricity companies, where electricity-related media coverage is dominated by AI, despite AI data centers being a nearly immaterial part of electricity consumption nationwide. Back in the dot-com bubble, interlopers were especially prevalent, as adding a dot-com suffix to the name of nearly any widget company seemed to grant instant access to that sought-after dot-com constellation. Investors need to be aware of these interlopers. There's an old media maxim which says, if it bleeds, it leads. It's a fairly cynical shorthand for the newsworthiness of a story. Stories involving conflict, tragedy, or violence will always get top billing in the media. That's mainly because these stories, well, they get the most clicks by the public. We're seeing this in real time right now, with America going to war in Iran. Other narratives, like the transformative potential of artificial intelligence, well, they've actually moved to page 2. Indeed, the Iran war story is essentially vacuuming up nearly all other narratives out of the media. No one seems to care anymore about weight loss drugs, the dollar debasement thesis, the tariff situation, electric vehicles, new legislation, and more. The Washington policy analyst at Stifel Investment Bank remarked last week, "It's like the oxygen has been sucked out of the room." The non-war narratives will eventually come out of hiding, either as the war winds down or perhaps as the newness of the war fades over time. On the left, we can see which narratives are presently on the move higher. None of these are really new, though the energy security narrative certainly has lifted higher since the Iran war started a few weeks ago. In the center, the Mag 7 megacap narrative has seen little progress in recent quarters and seems to be stalled for the moment. Perhaps that is a refreshing change from the prior years when the Mag 7s were dominating market performance. On the right, we can see the software as a service, or the SaaS narrative, is under serious pressure under the threat of competition from agentic AI, and that threat has become more palpable in the last 2 months. Indeed, we'll chat more about what folks are calling the software SaaSpocalypse in the next section. As you can see here, the SaaSpocalypse is indeed our third industry topic today. Why have the software stocks been so weak? Software stocks have been left in the dust by other tech stocks, as shown here. Over the past year, the IGV software ETF is down 7.8%, despite a 27.4% gain in the NASDAQ. The pressure is coming from a perceived competitive threat from agentic AI. Notably, the chip sector was up a strong 69% in the same period. In other words, the weakness in the software stocks was not a broad-based tech wreck. Rather, it was isolated to software as a service companies, or SaaS companies. The chart on the prior slide may not capture the magnitude of the wealth destruction we've seen in the software sector in recent months. This table shows 16 representative SaaS stocks with declines ranging from 20% to nearly 80%. That's a fairly harsh setback. Wall Street Journal is suggesting at least $300 billion in market value declines. Other pundits using a slightly broader definition of SaaS are suggesting wealth destruction on the order of $1 trillion. The initial catalyst here was Anthropic's release of its Opus 4.6, which included agent teams as well as business plugins. Investors panicked since one of the agent teams seemed able to do the work of 10 human analysts. This suggested that companies would be reducing seat licenses for many platforms like Salesforce or Workday. While the SaaSpocalypse has been a broad-based sell-off in software stocks, not all software stocks are equally vulnerable to the AI competitive threat. This chart shows a rough roadmap for which stocks are more vulnerable and which stocks are less vulnerable. The top of the list of the security companies like CrowdStrike and Palo Alto Networks, where the proliferation of AI is actually increasing the total addressable market by opening more vulnerabilities. Right below that, we have the major platforms like ServiceNow and Salesforce, where the platforms may well thrive by acting as a control tower for fleets of AI agents. The data infrastructure companies like Datadog and Snowflake seem reasonably well positioned to act as simple toll booths for AI. At the bottom of the list are the various point solution companies like Wix and Monday. These companies are vulnerable to AI replication of the entire business model. Most of these names have sold off rather hard. Also under pressure are the tools companies like GitLab and Confluent. We've been watching the SaaSpocalypse closely and looking for oversold situations that might be of interest to longer-term holdings. We recently added a new position in ServiceNow, and we continue to hold our position in Datadog. We'd like to move away from the high-profile topics of AI, the SaaSpocalypse, and the Iran war and discuss an intriguing niche in the biotech space, the new radiotherapeutics. This chart shows the growth of radiopharmaceuticals over the last dozen years, and it breaks down radiopharmaceuticals into three main radiodiagnostics, shown in red, blue, and yellow, and the radiotherapeutics, shown in gray. As a quick aside here, the prefix radio means the drug, whether diagnostic or therapeutic, is being combined with a radioactive isotope. Radiation for both diagnosis and for therapy is most common in cancer patients. What you can see in the chart here is a gradual growth over the years in all categories, but with one notable exception. The radiotherapeutics in gray really began to expand with the 2022 approval of Novartis's prostate cancer drug Pluvicto. Indeed, Pluvicto has become a blockbuster drug and is now doing over $2 billion a year in revenue right now. This ought to turn heads for those who have worked in the radiotherapeutic drugs area over the years. Radiotherapies have held great promise for decades, but have been challenged by both clinical and commercial hurdles that non-radiotherapies just do not face. Has Novartis finally cracked the code? This is a fairly busy table showing all the radiotherapeutics entrants in the research pipeline at present, as well as the very small handful of approved radiotherapeutics. It appears that Novartis's breakthrough is driving research into a variety of alternatives and variants. While most of the late-stage candidates are aimed at prostate cancer, there are also a handful aimed at gastrointestinal cancers. And earlier stage research is looking at radiotherapeutics in other solid tumors, bladder cancer, liver cancer, melanoma, and others. Certainly the Novartis success has captured the interest of researchers, but at a broader level, why the interest in radiotherapeutics? Certainly we've had solid clinical data, not just with Pluvicto, but with others going back many years. The latest round has moved away from radioimmunotherapies, which had strong clinical success but little commercial success, and now it's aimed at radioligand therapies. The radioligand therapies are still difficult to administer and manufacture, but are much easier than the radioimmunotherapies from prior generations. We'll talk a little bit about this on the next slide. I've thrown this slide in here partly for selfish purposes. When I first started covering biotech as a sell-side analyst, the first company under my biotech coverage was Seattle-based Corixa Corporation, which made a radiotherapeutic called Bexar, and was competing head-to-head with IDEC Corporation, which made a comparable drug called Zevalin. You can see both these names in the 2002 bubble, second to the left. Both these drugs showed excellent clinical data, but both flopped at commercial release. The drugs were simply too difficult to administer in the healthcare system at the time. Both drugs needed to be prepped on-site using customized dosimetry while trying to coordinate both the radiologist and the oncologist. The antibodies were large and did not clear the system quickly, exposing the patient and caregivers to gamma radiation for weeks. Novartis has addressed nearly every one of those shortcomings. The small molecule ligands clear the systems within hours, and radiation is a more cooperative form of beta radiation, not gamma radiation. Dosimetry is fixed, so no need for on-site customization, and Novartis has invested what they're calling theranostics centers, which put radiologists and oncologists in one place for better coordination. Novartis has basically torn down the wall that was preventing prior therapies, good therapies, from reaching patients in need, and Pluvicto has reached blockbuster status. There are a handful of big pharma and small biotech companies moving forward with next-generation radiotherapeutics in the oncology world. From an investor standpoint, the big pharma name lends much credibility to the various programs, though none are really direct plays on radiotherapeutics since the pipelines are so large. Radiotherapeutics basically disappears within those huge pipelines. Even among the small biotechs, there are only two that really are pure radiotherapeutics play, Actis and Perspective. We do not own Actis or Perspective right now, but both names are on the watch list, and we could be stepping up maybe over the next 6 months or so, depending on how fundamentals evolve. Actis is actually a recent January IPO, and while the stock popped to just below 30, it has since retraced that gain and is now within $1 of its original IPO price of $18. Notably, Eli Lilly bought a 12% stake in Actis on the IPO. That's a fairly big endorsement from a high-quality big pharmaceutical name. Actis's lead candidate, AKY 1189, will have phase 1b data within a year and is targeting bladder cancer using a unique Nectin-4 target. Cash per share right now is about $11, and after the IPO, that is, and burn rate right now is about $2.5 per share. On the right, Perspective Therapeutics, higher risk, higher reward play using a unique lead-212 isotope as a so-called Trojan horse platform, an isotope that starts as a modest beta radiation, but lead decays into bismuth, which then releases alpha radiation, the sledgehammer. The stock gapped higher a couple of months ago on a setback at a competitor's program, which leaves Perspective as a veritable sole survivor in the Trojan horse platform. Let's move on to our fifth and final industry topic with the curious title, Fertilizer Goes Viral. We're always a tad reluctant to highlight a stock of ours that has done especially well, don't want to jinx it, but CF Industries, a company that makes nitrogen fertilizer, has posted one of the best performances in the S&P 500 year-to-date. While we would love to take credit for our vision, we confess that CF has done well almost entirely due to the disruptions in the global fertilizer market related to the war in Iran. Not many folks are aware that nearly 30% of the global trade in nitrogen fertilizer comes from the Persian Gulf. Wholesale nitrogen fertilizer prices nearly doubled overnight after the start of the war. In addition, nitrogen fertilizer prices, they tend to track natural gas prices, the most costly component in the making of nitrogen fertilizer. Yet natural gas prices are priced regionally, whereas nitrogen fertilizer price, well, that's priced globally. And U.S. natural gas prices, well, they dropped fairly hard over the first quarter as concerns over that polar vortex cold winter subsided. Indeed, the decline in U.S. natural gas prices was actually part of our original investment thesis. Anyway, bottom line is that U.S. nitrogen fertilizer prices rocketed higher due to the Iran war. At the same time, the cost of production dropped like a rock because of warmer U.S. weather. The nitrogen fertilizer companies usually hide behind the larger potash companies that most people think of when they think of the fertilizer industry. But potash and nitrogen fertilizer have very different economics. All of the nitrogen fertilizer stocks have rallied year to date, but the potash sector is a mixed bag, some up, some down. Why? Potash is just not a big Persian Gulf product, so there really are no supply disruptions with potash, nor is potash made with natural gas. Bottom line is that the moon and stars have aligned perfectly for a sizable nitrogen windfall, but potash will just not see much benefit. The spike in nitrogen fertilizer is not a good thing for farmers, and farm state politicians reacted almost immediately. As we can see here, Senator Hawley from Missouri alleged that fertilizer companies are actually using a foreign crisis as a cover to impose unjustified price increases, restrict supply, and coordinate market behavior. Good to know Hawley is fighting for his constituents, but Wall Street basically ignored the allegations. After all, the supply disruptions are profound, and the pricing effects are worldwide and not limited provincially to just the U.S. If the Persian Gulf remains blocked and nitrogen fertilizer prices remain elevated, there will be ripple effects up the value chain. Corn is the most nitrogen-intensive crop in the U.S., and we are in the early part of the planting season right now. If farmers cut back on nitrogen application, yields are likely to drop, which could bump corn prices as we move closer to harvest. And of course, higher corn prices will push through to higher feed prices for meat, dairy, and processed food. Higher food prices at the grocery store could push through to higher CPI inflation, which will make the Fed reluctant to reduce rates. Of course, working through that whole chain could take over a year, and the situation in the Persian Gulf may see relief well before then. Before we conclude, we have one more slide looking at the stock market over the long term. We looked at this chart from Fidelity about a year ago. The bars in green are showing the return in each year between 1980 and 2025. The dots in black above each bar are the biggest rally in each year, whereas the dots in red below each bar, well, those are the biggest drops of each year. For example, in the last year, 2025, the market gained 17.8%, but along the way, we did see a decline of 19%, and we also saw a rally of 40%. Going back to 1980, the average annual return is 13.3%. The takeaway here is that the stock market is indeed volatile in the short term, but the long-term gains are more consistent. Patience pays off. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.